Yo, we are here. This is Finance Musings, episode 3. Third time's a charm. I don't know. Is there like a big number 3 that's famous? I'm trying to think. Wait, was it AI number 3? Anyway, let me get focused, guys. No, everyone, welcome to the third episode of Finance Musings. I'm really excited about this. I know I talked about kind of having a new layout where maybe I'll make some decks and models that I speak to companies or things that I'm talking about, but I also kind of want to touch on I do read a lot of things. I love reading investor letters, and one of my, I love Howard Marks so much. Every time I read one of his memos and memos that he sends to the Oak Tree clients, I'm like, man, I would love to meet Howard Marks. He's like, I feel like he's talking to me when I read what he's written, and he writes. I'm like, man, like, this is the guy. Howard Marks is a guy, and I believe this is the memo, and I'll tell you guys, and it's on the website. The link's in the bottom of the description of the video, but this is from July 29th, 2021. And man, now that it's December 2021, almost 6 months after this, man, I'm getting goosebumps because he's so good. A lot of things that he talked about in this memo regarding the Fed, inflation, just spot on, absolutely spot on. I would follow Howard Marks blindly to an extent, but probably some caveats to that. But I mean, I'm really impressed with. I didn't realize he wrote this in July. For some reason, I thought he wrote this in November. So I was like, oh, cool. Maybe 4 weeks later, he's kind of on point. Makes sense. But no, he wrote this shit in July. This was published July 29th, which means he probably started writing this like in July, end of June. Digested information and thoughts that were coming out, and for him to be this accurate, it's actually really scary. I'm actually like literally getting goosebumps right now. But so I want to get to the top of the memo, and I don't know if I'll be able to cover the entire memo in this episode because it'll just be like an hour long. But the genesis of kind of this episode is, the title of his memo is called "Thinking About the Macro," and it's interesting because a lot of investors think you have to make things complicated, right? Like, hey, what are these macro factors? What are these geographical movements, and how do they impact my investments and all that? And to a degree, things are correlated, but they might not be correlated as to why you think they're correlated, right? But the biggest thing that I took out of this memo to kind of reinforce some of my beliefs, which sometimes when I read things by Howard Marks and other folks that I like, I ask myself that, am I reading things that align with my mindset? And that's why I'm so beholden to their views. And I'm like, you know what? I totally agree with this guy, and maybe that's why it just resonates with me so loudly. Excuse me. But the biggest thing that I wanted, there's several things that he broke the memo up into, but the three biggest things that I want to talk about is inflation. What does the market know, and how does that doesn't make any sense. How does macro analysis, macro forecasting, does that have any sort of impact on how we analyze things and what have you? So I'm just going to start from the top of the memo and kind of highlight a few things that he said that really resonated with me that I want listeners to take away. And it's something that I preach all the time. It's not as simple as just buying and holding, but it's buying and holding and understanding that not everyone who is in the game, in this ecosystem, in the game ecosystem being defined as being an investor in a variety of asset classes, not everyone is looking at the fundamental truth of what that asset is performing, right? Is it simply quite, in your opinion, is it underpriced or overpriced? And if it's underpriced, are you buying? And if it's overpriced, are you selling, right? And do you have that sort of discipline to do that? I don't, but for now. So this is right off the top of the memo. He says something that I think is so true, right? And I think this is really important for a lot of investors to think about, because this speaks to consensus thinking, group think, and again, macro forecast. So there's a quote from Warren Buffett: "For a piece of information to be desirable, it has to satisfy 2 criteria. It has to be important, and it has to be knowable." I mean, that's a fantastic quote, right? Because as Howard Marks says, the reason for this is simple. To use Buffett's terminology, we're convinced the macro future isn't knowable, or rather macro forecasting is another area where, as with investing in general, it's easy to be right as a consensus, but very hard to be more right. So that's the key thing, that like when I feel like Howard Marks is just dropping bars. I mean, look, to folks out there, they might see this, whether you're really, really sophisticated or not. You might be like, all right, Sachin, you know, they're bars to me because I'm like, this is stuff that people don't think about. Just read that again, right? Or rather, macro forecasting is another area where, as with investing in general, it's easy to be as right as a consensus, but very hard to be more right. Consensus forecasts provide no advantage. It is only from being more right than others, from having a knowledge advantage, that investors can expect to dependently earn above average returns. So that's the thing, right? Is that you have these consensus guidance that gets issues, macro forecast. Everyone's kind of more or less the same. And we're going to get to that later. He has a really, really, really good breakdown of data of like how wrong forecasters are and whatnot. Is that, hey, unless you truly have a knowledge advantage, that is the only way that you're going to be able to have dependably above average returns. And that's why, you can't depend on, hey, what is a consensus macro forecast say, right? Because that's the information that everyone has. So if you're basing your actions based on information that everyone has, what is your advantage in making that decision? So again, I remember I was reading this memo and I was like, damn, I'm 2 paragraphs in and I'm like, I've been thinking about this for 10 minutes. Meanwhile, this is an 11-page memo. I'm like, when am I going to finish this, right? So this is part of the memo that I really like, right on this first page, right? So here are the 3 quotes from here, right? So most macro forecasts are likely to turn out to be either unhelpful consensus expectations or be non-consensus forecasts that are rarely right. So I want to speak to that point A, is because again, if your expectations, consensus guidance that's issued whether by the company or research analysts or whatnot, it's all the same, where is that advantage going to come from? What sort of value add are you getting from your own, your own de novo analysis, right? If you're not doing that. And then this other thing right here is B, is non-consensus forecasts are rarely right. And, if I want to point to this, I don't want to call out anyone specifically, but there's so many short sellers who just go on seeking alpha, right? There's so many bears who like continually push out, oh, this stock is going to go down. And it's like, bro, like look at your track record, dog. You've been wrong every single time, right? And again, what are you basing your forecast off of, right? And now getting to the third point here, right? And this is a lot, I think, for a lot of folks who retail investors out on their own, and even, folks who work at funds and whatever, institutional funds, whatever the case may be, if you're a PM or something, right? This is really, really huge. It may be hard to admit to yourself or to others that you don't know what the macro future holds. But in areas entailing great uncertainty, being agnostic is probably wiser than self-delusion. That is insane. That requires such self-awareness to say that, hey, like, I don't know what the future holds, but guess what? That I don't know what's going to happen. So let me be agnostic to the situation, then delude have the delusion into thinking that I can figure out what's going to happen based on my forecast, right? Or consensus forecast, right? I do want to speak to a few other pages. I mean, there's a lot I want to speak to. So again, I will have to probably cut this up into 2, but these are really, really good quotes from Mark Twain. And so the first quote is, it's frightening. And just think about how many times people make investing decisions based off of a meme page or based off of a IG post or like a quick 30-second TikTok, right? And so that's why these are really like resonate with me, because I feel like so many people are following investing advice, without doing the necessary due diligence on their own, right? So this is huge, right? It's frightening to think that you might not know something, but more frightening to think that by and large, the world is run by people who have faith that they know exactly what's going on. That's huge, right? Because you're admitting yourself, hey, I don't know if this security, if this asset is going to go up or down. But then the reality is that there are more people, more than not, that people have faith in what they're doing. So like, hey, this stock's going up, this stock is going down. And you're there kind of like, hey, I'm going to blindly follow that, and doesn't always work out well. And this Mark Twain quote is fantastic. It ain't what you know that gets you into trouble. It's what you know for sure that just ain't so. And look, I've been burned many times, right? I can take Upstart, for example. I think Upstart is a great company that I personally am invested in as of December 15th, 2021. And I'm personally invested in Upstart. I think they have a lot of market cap. They have a lot of addressable market that they could go into. I think they have a competitive advantage with their technology. They are profitable on GAAP measures, right? Their CEO is hyper focused on, hey, I'm building the business, reinvesting into the company. Great company, right? And sure, maybe they were overpriced, halfway through 2021, kind of mid to late 2021, and as of right now, they're down dramatically, 50+%. Now, I had faith in saying, hey, I know exactly what's going on. This is a great company, great fundamentals, great room for growth. I'm going to bet a lot on this company. But guess what? That's what I thought was going on. Not what the market thought was going on. Clearly, it's what you know for sure that just ain't so. So while the company might have great fundamentals, and I'll do like a breakdown of Upstart later, is what I don't know is that guess what's impacting that stock, right? Hey, what is the Fed going to do? What's going to happen with inflation? How the market's going to react to that? Are there folks in the market who are going to take things at the top because like, hey, I don't want to, hey, this is going to be negative for the company. I'm not in it for the long run. I'm going to take my profits and go. Then other traders might have stop losses. And then it's just a perpetual like selling. And it just kind of bottoms out, right? And that's when I really want to skip to the inflation part, but I backtrack a little bit. Remember Upstart and inflation and what's happening to the stock as of December 15th, 2021, right? So, yeah, I want to pivot back to what Howard Marks was talking about and how much he, I love this quote. He's like, having gotten everything off my chest concerning the shortcomings of forecast, I'm going to devote the rest of this memo to thinking about the future. So, this is what I like, what he says are the best, right? Howard Marks was like, when I think back to the years leading up to 2000, I picture a market that largely responded to events surrounding individual companies and stocks. Since the tech bubble burst in 2000, however, the market has appeared to think mostly about the economy, the Federal Reserve, and the Treasury and world events. That's been even more true. I'm a mess right now, guys. I'm sorry. That is even more true since the global financial crisis in 2008. That's why I am devoting a memo to a subject I largely disavow. Now, I'll try to enumerate that. I'll hold off on that. Think about what he said, right? He said, hey, up to 2000, which I'll take that with a grain of salt because the tech bubble, no one was looking at events around. Well, sorry, they might have been looking at events surrounding individual companies and stocks, but maybe some of the fundamental analysis and drivers of that weren't there. But I have to agree with him. I have to wholeheartedly agree with him that, hey, since 2008, think about what everyone was watching on CNBC, Fox Business. Everything moves off of world events, geopolitical events, national events, elections, state, local, House and Senate flipping. What is the Fed going to do? Everything is driven by these events, right? Which, look, and Howard Marks points this out later, and I'll wholeheartedly agree with him, is that, yes, that these are all events that 100% will impact a company because of the larger trickle-down effect of, hey, what does inflation mean for rates? How do those rates, there is a wide-ranging cascading effect on everything, right? Consumers, businesses, at what rate banks lend money out, and how does that trickle down through things? So yes, look, that is there, but the point that I think Howard Marks is making, and I truly agree with him, is that there's too much movement that's happening based on noise, right? Versus like, hey, let's actually look at what the company's doing. First of all, are you profitable on a GAAP basis? Sure. What's the addressable market? What's your moat? Are you executing against your business plan? What is the management team's POV? Meaning that, hey, this is a CEO who's reinvesting into the business. He believes in building a company. There's, looking at things that the company's actually doing, right? What are their sales growth look like? How have their sales been sequentially quarter over quarter? What does that mean? What's their free cash flow? What's their cash on their balance sheet, right? These are things that matter and drive to be like, hey, is this a company that I personally want to invest, my own capital in? And, to end this part about kind of his intro into the letter, I mean, this is just fantastic. I love Howard Marks. If you ever see me and I ever see you, I will be asking. Oh, sorry guys. I will be asking for a autograph and a photo so I could hang it up. And just me and Howard commentary finance musings right now. is this right here. That reminds me to put forth my conviction that we all have views about the future. But as we say at Oak Tree, it's one thing to have an opinion, but something very different to assume it's right and bet heavily on it. That's what Oak Tree does not do. Man, that requires such great discipline. I think you need to like apply that to your life, right? Think about how many times you have an opinion on something and assume that you're right about it, and you go with that idea, versus realizing that, hey, this is just my opinion. It doesn't mean that it makes it right. And that's why Oak Tree is Oak Tree. I wonder how it's gonna sound. I really do need to apologize, guys. That pre-workout did not kick in. Tyler, I need a refund on my C4. Yes. C4 did not kick in. No, look, but jokes aside, that's why Oak Tree is Oak Tree, and they're good at what they do, right? So that was just kind of to preface it. I know went a little bit longer than I wanted it to, but I think that's really important, and that just shows the discipline that they probably have as a firm, and that shows the discipline that he's had as an investor and why he's so successful. And every quote I read I'm on page 2 right now, and everything I read from Howard Marks is just straight. It's gold, And it gets you not only questioning, hey, how am I investing my money? But then it gets you questioning, wait, what am I doing in my personal life that doesn't align with this? Because these are kind of truths and pearls of wisdom that you can really apply to anything, in my opinion, right? So, anyway, inflation, fuck. This is huge. I'm not going to get into what the Fed announced today, and there's a lot that happened, and for whoever watches this in the future today, actually, I should do an episode on that later. But just to understand the foresight that this man has, he wrote this in July 29th, 2021. All right. So this is what he wrote for inflation. As of this writing, which was July 29th, macro considerations are certainly in the ascendancy, centering on the subject of inflation. Over the last 16 months, the Fed, Treasury, and Congress have used a fire hose of money to support workers, businesses, blah, blah, blah. This has resulted in confidence in the prospects for strong economic recovery, skyrocketing asset prices, and a fear of rising inflation. Now let's tackle those one at a time, right? Now, I think what he's going to get to, and as I read this, I was thinking about this, it's that because of the support that we have been getting, that, hey, the market has confidence that this economic recovery is not only going to last for a long time, but it's going to be a strong recovery. But what's the underlying driver behind that? And it's kind of like, the emperor with no clothes, right? How long can he ride the wave? Second point, skyrocketing asset prices, right? When I spoke about Upstart, and then see the fear of rising inflation. And there's a great cartoon that he has later on page 3, I believe, that just speaks to the madness of all this, right? But keeping those 3 things in mind with some of those examples. Now, this is what traditionally the thought process is, right? And he does a great job of kind of highlighting this, right? When you're in a downturn, everyone steps in, let's prop things up. So people, according to traditional economists, traditional economists, this is what would ultimately get produced, right? Is the following. Oh, excuse me. Sorry, guys. Charging my iPhone. Is a stronger economy than otherwise would have been the case, which is true. Higher corporate profits, which was also true to an extent, depending on what sectors. Tighter labor markets and thus higher wages. This probably trickled on back half of 2020, early 2021. Became true. More money chasing a limited supply of goods, which also became true. But again, this fourth point about money chasing a limited supply of goods is also born of supply chain issues because of COVID. And so, but also 4 is also true. Number 5, an increase in the rate at which the prices of goods rise, i.e. higher inflation, which again, probably started early 2021 and is now really rearing its ugly head as we've closed out 2021. And then the last thing, a tightening of monetary policy to fight inflation, resulting in higher interest rates. Yo, Howard Marks can see the fucking future. Dude. I mean, but look, I'm not saying Howard Marks can see the future because like he said, hey, this is what you expect. This is the traditional thing. Now, obviously, that no one can predict the timing, so it's easy for me to say in hindsight, reading this in December, it's like, oh man, like he's so smart. And look, I know I'm really biased towards Howard Marks because like I said, I'm really biased towards him. I think he's great. I love reading his memos. I'm here on page 2 of his memo. I've been talking for 20 minutes, right? So I'm not trying to sit here and say he's a genius, but understand that this is what would be expected. And to an extent, some of this stuff has come true, but again, it's what was expected, right? And then as we go to page 3, I'm not going to read all of this, but I want I want to skip through some of the inflation. The like this is what was huge. Remember that first part about hey, this is what happens when we prop up the economy. This is what we think is going to happen, right? The one thing that I wanted to highlight, and I should have really had this pointed out, targeted. So this is it. This is it right here, right? So okay. So 1970 to 1982, a bunch of shit was going on in America. No one knew what to do to combat inflation until interest rates were raised dramatically, right? And dramatically, right? So that's between what, 1980 and 1982, and that's what ultimately kind of reigned in inflation. But what's really important, that's stuff everyone knows about. What's interesting is that right here, what he writes: for years, central bankers in the U.S. and Europe and Japan have targeted a healthy 2% rate of inflation, but none of them have been able to produce it. This despite continuous economic growth, significant budget deficits, rapid expansion of the money supply through QE, and low interest rates, all of which are supposed to be inflationary, right? Now, it's like, wait, all this stuff is supposed to, there's a causation, right? But it's not happening, right? So what's interesting is, what I appreciate about Howard Marks is he's able to say, okay, this is what we're expected to bring about, what we're expected to see. We look at history, what happened, how do we combat high inflation in the past, what has that done? And look at this right here, right? The low reported U.S. inflation rates may be partially attributable to changes in recent decades in the way the CPI is calculated, which is true. The CPI is flawed if you look at what's going into it. But this is what he's getting at, is we know and this is, again, I could probably make this 10 minutes long, 10 minutes shorter. We know very little about inflation, including its causes and cures. I describe it as mysterious, so I believe we should put even less stock in predictions surrounding inflation than in other areas. However, that makes life tough for investors at the moment because inflation and its impact on interest rates constitute the most important wild card. So, you go full circle as like, hey, at the start of the paper, it's like, hey, macro forecasts are wrong. You don't know what you don't know. You think you're right, but it's just an opinion. Don't bet on it heavily. The market reacts to things that don't really speak to the underlying asset. But then as a retail investor, like, hey, that's great, but what do you want me to do, right? Those external causes and noises are affecting the price on the asset in which I've invested in, right? So not only is my principal, my capital in the stock, the appreciation is my appreciation on a stock is racing against not only inflation, right? Because think about it, your appreciation on your stock is racing against inflation. At the same time, you need to ensure that there's enough sales and revenue growth for the company, for the company to grow into its valuation or what it could be. Now, whether that's, hey, just a multiple expansion or the actual business scaling, which leads to it being valued at a higher forward trailing multiple. Excuse me. But at the same time, then you're thinking about the fact that, hey, what is the impact of all this having on the actual purchasing power and value of my dollar, which is my capital, into this asset, right? So it's like, fuck, like you're really racing and battling so many different things, right? Inflation, actual growth occurring or not occurring, and could that growth have been captured elsewhere? So the growth you experience in another asset could potentially keep pace with inflation, ideally offset it or really offset it, and you see growth that would supersede the devaluing of the value of your dollar, right? If the value of it is actually decreasing, right? That's a lot. So I mean, when he says that sentence, I agree with him. It's like, hey, it's like, bro, this is all great, this is all true, but like as a retail investor, that has nothing, like, bro, that makes my life tough, right? Because what do you want me to do, right? And it sucks because, the genesis, and I'll try to close this out because so many more gems and so many parts I want to get into is the reality is that this all impacts your decisions, right? That you do, okay, I want to invest into this, into this particular stock or whatever the case is. And I can totally see why someone like Warren Buffett is just like, hey, if you're a retail investor, man, sure, you want to pick a few core positions and, go down that route. But index funds, man, diversify 75% in index funds, 25, 25, 25, into different types of index funds. It's growth, value, small growth, whatever the case is. There's plenty of great index funds out there, semiconductor focused growth, semiconductor focused index fund, whatever the case is, right? Fintech focused. There is a there's a lot there, right? But and that's where he's coming from. I forgot the point I was getting at. I'll circle back to that, right? What I'm taking away from this, and that I want everyone who's watching this to take away from that, is that, hey, look, like the reality is that while there is a lot of noise from external factors now, whether that's, hey, what is the Fed doing, what is the economy doing, the reality is that your decisions that you make, whether you invest into a stock or not, should not be driven by a meme page. It should not be driven by, hey, what are these market analysts saying, and all these other things. Well, my girlfriend is actually texting me right now, and let me just tell her, I'm actually just going to send her video, give her a quick mid shout out. Hold on. Oh, hey, love, I'm actually in the middle of recording right now. I love you very, very much. Let me respond in a second. All right. I'm just recording right now. All right. I love you. Bye. No, but so with that being said, guys, is that I'm always going to push for doing a bottoms up. You can do a bottoms up and top down analysis, right? Macro forecasting doesn't mean, oh, hey, what is going to happen in 5-10 years with sales growth and, revenue growth, and what is, how is this department going to perform? A part of it is to truly understand and say, is the asset today, as of today, is it underpriced or overpriced? And how do I do that, right? What am I looking at? What am I understanding about the business? What am I not looking at? What am I thinking at objectively, right? And that's what I'm hoping that people get out when you read this memo. And look, if someone reads this memo and is like, hey, Sajin, you're missing the point on what Howard is saying, and this is how you should look at companies or whatnot, my thing is that I'm going to continue to not be afraid of what. It's funny, like, as I say this, someone like screen clips this in like 10 years, I lose my half my portfolio value because I'm like, yo, buy and hold, guys. But the reality is if you're in the game for more than 5 or 10 years, right? And my age range, everything I'm invested in is a forever stock, right? There might be some growth stocks that are like 3 to 5 years and maybe capture the upside and then leave like a small position, but then take your profits and reinvest it into like another growth stock, right? Like kind of not to just balance overweight positions, but more so, hey, if like we think a company has grown into its valuation, it's reached a cap, it's like, hey, let's take the profits that we can because we think that, hey, well, this is fairly priced, maybe a little overpriced. It's kind of, it is where it is. Let's capture those gains and let's rebalance it and reinvest those gains into a, another growth company, whatever else pops up in the next 3 to 10 years, right? So there's that stuff going on, right? But I think that's something that's really, really big that a lot of people do not do and act in the short term, right? A lot of people drive and make decisions on the short term. And it was funny, I was talking to one of my really good friends, Ashish, yesterday about this, is that, reacting on market Fed news is like, hey, guys, let's focus on the fundamentals of the business. So, okay, guys, I'm getting away from talking about the memo, which is what I, want to do. I just want to give a little rant on kind of my thoughts on what's kind of happening and not happening. But on episode 4, I'm going to finish this and I'm going to kind of breeze through. He does a really good job of talking about, hey, what are his thoughts on inflation today? What does the Fed know? Really, really, really good part. Those are the 3. I think after that, I think I'll kind of give like a recap. But this is the part that I really wanted to talk about is inflation today. Inflation today, what does the Fed know? And what does the market know? And I'll kind of close out with that. Oh, sorry, 4 things. And then what do the forecasters know? And actually, let me end it with a quote like this because this is just a beautiful, beautiful, beautiful quote. The bottom line is that hundreds or perhaps thousands of people make their living as professional market forecasters, despite the fact that the median forecast is of no value. Wrong on average, positive in good years, and bad, and way off target when an accurate forecast would have been most profitable. So with that being said, I'm looking forward to episode 4. I'll kind of dive into a little bit of that and my thoughts on that. But for those of you who want to go and check it out, links in the bio, or just go to oaktree.com, go to his memos. Fantastic stuff. I love Howard Marks. Man, what a great investor. I mean, just Howard Marks is the man. Anyway, guys, with that being said, I'll see you guys on episode 4. Take care, guys.